Hello, everyone. You guys having fun? You're about to hear about tax. Come on, that's an exciting topic. I know that I'm kind of an oddball here. I'm a nerd when it comes to this stuff, so hopefully you will indulge me a bit for being happy to talk about taxation. But before we do that, I want to make sure that you understand something. It's adult time, okay? I'm a lawyer. I specialize in tax, estate, and business law, but I'm not your lawyer. I'm a wealth advisor. I own a private wealth management firm as well. I own a tax firm, so I'm a tax advisor too. But I'm not your wealth advisor. I'm not your tax advisor. So the purpose of this event is not to give you any specialized, personalized advice, right? We're all adults. Put on our adult hats. Just know that this is for entertainment and educational, informational purposes only. Before you do anything, you should always get specialized counsel from someone you trust, and then get a second opinion and a third opinion. So what I'm going to share with you tonight is really designed to help inspire your thought process so that you can go back and ask some really good questions of those you trust. Now, the concepts that we're going to talk about right now, I really want to make sure that we're on the same page, right? So I want a little bit of audience participation. What do you think some of your largest expenses are in life? And again, we're going to talk about three, but just go ahead, yell from the audience. Mortgages, housing, taxes, food. Yeah, so let's talk about this a little bit in concept, because again, we're gonna have the top three. So number one, number two, and number three. So I heard taxes, I heard food, I heard mortgages, children, that's a big one. You see, when you actually want to break this down, let's go in reverse order, because I want to make sure that I don't lose anyone. The very first thing from an expense standpoint is the cost of family. I know that may sound crazy, but in reality, family is one of your largest expenses. Raising children today is not easy if you have kids, if you have a spouse, and even if you're alone on your own, it costs money. The average individual in the United States right now spends about $73,000 a year just to live. Food, housing, general entertainment, cost of raising kids. So these costs are pretty significant. And when you tie it in to understanding how this plays out, the second highest expense we have is tax. Right now, the average individual in the United States funnels somewhere in the neighborhood of close to 50% of their income into taxes. Now you may say, well, wait a minute, Edward, my tax bracket's not that high. We're going to talk about the journey of a dollar in a second. The third highest, meaning number one on this list, we're going to come back to that at the end. What I want you to understand is that every dollar that comes into our system right now, really goes through this journey. And I call it the 5 erosions. When we're talking about how money travels through our system, the very first thing we can think about is this concept of you earning money. When you earn money in the United States, you know what they do? They tax it, right? It's called an income tax. But that's not it, right? You have money now, you worked hard to earn it, and you go out and you spend it. You know what they do? They tax you. It's a sales tax. Now, when you go out and you actually buy stuff, after they've taxed you when you earned it, and they taxed you when you spent it, and if you go ahead and sell that thing that you just bought, you know what they do? They tax that too. It's called capital gains tax. And really, even if you go out and you don't want to sell what you just bought, you hold on to it, some things that you go out and buy, right, things that you own, the stuff that you have, you know what they do with that? They tax it as well. It's called property tax. And here's the kicker. When you die, you know what they do? They tax you again. It's called an estate or an inheritance tax. Like if you're working really hard to go out and build real wealth, that journey of a dollar in the economic cycle is taxed at least 5 times. Now, there are a bunch of other taxes as well, guys. And that's why I say the journey of a dollar typically results in about 50% of your income being subjected in some way to taxation. Now, most people just focus only on the income tax, right? They focus just on that concept. But the reality is tax is part of our everyday life. And what's really curious is to understand, how did this all happen, right? You see, before 1913, in our society here in the United States, before 1913, there really wasn't an official income tax, with an exception. You see, most of the operations of government prior to 1913, they were funded through this concept of tariffs and excise taxes. Now, there was an income tax, and it was used in order to help fund the war effort, the Civil War effort, but that was quickly repealed after the Civil War ended, and it was repealed because it was considered unconstitutional. So you know what Congress got the interesting idea to do in 1913? Anyone know what happened in 1913? Federal Reserve was created, one of my other enemies. Well, there was this thing called the 16th Amendment. The 16th Amendment essentially took all of the complaints that Congress was having and being challenged on, meaning a taxation system was unconstitutional, and they simply made a constitutional amendment saying it was okay for Congress to go out and tax income. You want to know an interesting point of fact here? You know how they got this thing to pass? Because you had to, in order to ratify a constitutional amendment, you have to really get all the states, at least many of the states, to say yes, right? You had to get buy-in. You know how they did that? They said that the tax would be temporary. How'd that work out for us? They lied. But the reality is, when you do look at the 1913 institution of taxation, the very first 1040 came out of that, the dreaded 1040. What was interesting is that the top rate at the time was 7%, and it only applied to incomes of $500,000 or more, which is the equivalent today, if you adjust it for inflation, depending on who you ask. Don't ask anyone in Washington, D.C., because they have stupid ideas about inflation. But the reality is that's about $13 million today. So you had to earn $13 million a year before you even hit the top tax bracket, which was a whopping 7% back then. But the reality of the tax code, that evolution, that's just what we have to live with. And most people live with it in a way that is passive, meaning they simply sit down and just deal with the reality of having to write a big check every year. But I want to tell you a little bit about why I'm so passionate about this. I didn't come from money, right? So my family, we were pretty poor. We had to work pretty hard just to get up to the poverty line. So I didn't come from money. I didn't learn about money when I was a kid. I learned about money as an adult, really sort of by accident, because the concepts of money for me were, we can't afford it, right? That was the mentality that I grew up with. Anytime that I wanted something, I love my mother to death, but she didn't come from money, and she was never taught money principles. So every time I would request certain things, and pretty much anyone in my family, the common response was, we can't afford it. How many can relate to that? We can't afford it. Say, I can't afford it. But you can afford it. You just need to learn the processes, learn the system. Because the reality is, when I got to a point in my business, when I was getting started, I predate Google and YouTube, guys, but when I started my first financial planning practice back in 1998, I struggled a lot in the beginning. I didn't make money in the beginning. But when I finally started making money, I put myself on this journey to getting to what I consider to be the milestone of success, right? 7 figures. How many people think that 7 figures was something, at least when you were growing up, was something to be like, wow, right? 7 figures, right? For me, that was like the echelon of echelons. It was the top of the mountain. There's nothing greater than that. And if I hit 7 figures, I have achieved success. That was the passion that I had and the thought process that I had. But the rude awakening happened on this chilly morning in April. I finally hit 7 figures. And I was over the moon. Like, it was the biggest accomplishment because I was the first person in my entire family ever to go to university. I was the first person in my entire family to ever break through into the 6-figure digit number. And I was the first person definitely to hit 7 figures. And I was over the moon. But I walked into my accountant's office. Let me set the scene. There was this interesting desk, like a mahogany desk. I can remember it. And I remember that on the desk, have any of you ever been in a room that just smelled like paper? It smelled like paper. It's like, and there was a slight hint of coffee. But there was paper all over the desk. And I can remember sitting there, and I can remember him telling me, Edward, you had an amazing year last year. You should be so happy. You should be so proud. And I was smiling at the time because I was happy and I was proud. And what I learned that day is that taxation is theft. Because the rude awakening I had was him telling me what my tax bill was. And I had to write a check, a real check, $350,000. Because I hadn't paid anything throughout the year because he didn't tell me to. And I just assumed that the accountant knew what he was doing because he had a big fancy office and a big fancy mahogany desk. It was always filled with papers of other people's tax stuff. So I imagined that he was busy and that people trusted him and I had to trust him. But I learned that day that if you don't know, you're the one losing the game. If you don't know the rules, you're the one losing the game. See, the reality is the wealthy are sitting around playing chess while all of us are sitting around playing Legos. That just is what it is, right? That's the truth. Say truth. Truth. The wealthy are playing chess while most of us sit around playing Legos. But here's the secret, guys. The rules are published. The tax code is written. And if you want to, you can read it, or you can find someone who has. And what I felt when I had to write that check, this is how I felt. Right? I was like, oh my goodness, are you serious? 6 figures? I had to write a check to the IRS. Now, what ran through my head and what most people were telling me, because it's hard to keep that a secret when you felt that way, right? So I would tell the people that I trusted, like my friends. I didn't talk about money a lot at that point in time in my life because I was still young with it. I was still new with money. So I didn't really know how to talk about it, so I was really closed. But my close circle of friends, I would talk about it, and they would say, you know what? Benjamin Franklin says there's nothing certain in life but death and taxes. How many people have heard of old Ben saying that, right? Well, I thought to myself, is that true? Now, don't get me wrong, I can do anything about the death part, right? That is what it is. But the taxes part, I started thinking, well, wait a minute, you have people who are not really paying a lot in taxes. There's a lot of people out there that aren't paying a lot of taxes, right? We hear about it, especially now with social media, we hear about it all the time, right? People not paying their fair share. I hate that phrase. Fair to who? Fair to who? I'm an unapologetic capitalist now, guys. Unapologetic. The IRS, the government, they have way too much. How do I know that? Because they do stupid things with our money. Everyone say stupid. Stupid things with our money. So at the end of the day, I have made it my passion to figure it out, to learn the rules, because I don't want to give them a darn penny. Not if I don't have to. So I've been spending my time figuring out what those rules are. And when I learned what those rules are, I learned that it is actually possible to outsmart the IRS. Because most of them don't know what to do. So who's with me? Who wants to outsmart the IRS? How do we do that? Well, I'm going to talk about 3 tax reduction strategies with you guys. Now, the concepts that I'm about to share are only inspiring you to think, hopefully. You should go back and ask questions of those you trust who have been helping you in the past with regard to these financial matters. You should ask questions. And here's a magic word that you should put in the front of your question. It's how. Everyone say how. It's how. Everyone say how. How. How can I do X, Y, and Z? Not can I. If you ask an accountant, can I do X, Y, and Z, the simple and easiest answer for them to give you is no. Why? Because it lets them off the hook, right? If they say no, then they're not necessarily going to be liable if there is a mistake, and because they maybe just don't understand the rules and the concepts. It also is easier because then they don't have to do work. Most accountants, again, I've been doing this for 2.5 decades, most accountants are little more than glorified historians. They spend all of their time, their effort, and their energy just trying to figure out how to best tell the IRS what already happened. It's a last year thing, not a tomorrow thing. So if you're having that relationship with that financial professional and you're not asking the how questions, well, then I say shame on you. You're the one responsible for your own life. No one's coming to save you. I'm trying to educate, trying to help uplift, but at the end of the day, I can't do the push-ups for you. You got to do it. You got to ask the how questions. Now, the strategies I want to talk about first and foremost is making sure that if you're operating a business in the United States, you're selecting the right entity structure. You see, when you look at the tax code itself, it's simply a recipe book. And it's nice to have the recipe, but you need pots and pans. You need an oven, right? You need the stuff to make the recipe possible, right? So you can have your cake and eat it too. But if you don't have the right structures in place, you can't take advantage of it. And I want to talk about just one item with you guys today on this topic. There's a lot to do with it, but this particular topic is this one piece of paper. It's called Form 2553. Anyone heard of the 2553? 1, 2. You guys have been following me on social media, I think. Form 2553 is what's called a tax election. There are about 33 million small businesses in the United States right now, about, if you're measuring them by employee size, 100 employees or less. The vast majority of those small businesses have no formal structure whatsoever. They're called sole proprietorships. Everyone say sole proprietorship. Sole proprietorship is the worst form of business structure possible. It gives you no asset protection whatsoever. So God forbid if something happens, everything that you have is potentially subject to liability. So you never want to be a sole proprietor because it's so simple to put some form of entity protection around your business. But the concept here is when you do select something, the second most common form of business structure in the United States is something called a limited liability company, an LLC. If you've heard it, say LLC. LLC. A limited liability company is a very basic form of entity structure, and it gives you what's called asset protection if you operate and manage that LLC correctly. But an LLC gives you no tax benefits because all it is a legal structure. It has nothing to do with taxation. A lot of people think, oh, I need to form an LLC because it'll save me taxes. If you've ever heard someone say that, they are not a real tax professional. An LLC has nothing to do with taxation. But Form 2553 does. What that allows you to do is it allows you to tell the IRS how you wish to be taxed if you are an LLC. A lot of people don't know that. See, if you don't tell the IRS how you want to be taxed and you own this LLC yourself, it's called a disregarded entity. Say disregarded. Disregarded means that you are personally taxed for the income and activity of that particular business. Not necessarily a good thing. Form 2553 gives you the ability to tell the IRS instead that you wish to be taxed as an S corporation. How many people have heard of an S corporation? Now, the reason why an S corporation is so impactful and can help you save money on taxes is because it gives you this ability to change how you are paid. You see, if you look at your financial life, there are a lot of different categories of income, but I'm going to just talk about 2 general ones for now. Okay? We have non-passive, and we have passive. Non-passive is if you are actively engaged in business. So if you are an LLC that's a cake shop or a bakery or a coaching business or a digital marketing company, whatever it may be, if you're active in that, then the income that you're generating is non-passive. And the problem with that is that it immediately puts you in this category of self-employment income. And the challenge with self-employment income is that it is subjected to two different types of tax. It's subjected to income tax, as we talked about earlier, right? But it's also subjected to something called FICA, the F word when it comes to taxation, the dreaded FICA tax. That's Social Security and Medicare. The problem with FICA is it's another 15.3%. 15.3%. Now see, it's actually two taxes in one. The first tax is Social Security tax, 12.4%. The second tax is Medicare tax, which is 2.9%. So together, that's 15.3%. So the challenge with self-employment income is that you're subjecting yourself to self-employment tax, then additional income tax based on whatever your tax bracket is. So let's look at an example of this, because I think it's critical to see numbers, at least when I'm talking, because I drone on at times. Let's imagine for a moment that you earn $150,000 a year, as an example. So right now, let's assume that you have $150,000 a year in income, and let's say your expenses maybe another $50,000 a year. So you spend $50,000 a year. What do you net? 100. I love the fact you guys can do math. This is good. It's good. We're going to get along here. Now, the challenge with $100,000 is, again, let's assume all the expenses are accounted for in that 50. That $100,000 is going to be subject, we're going to ignore the income tax for a minute because that's going to happen no matter what, but it's going to be subjected to this self-employment tax, this SE tax, right? Self-employment tax is going to be $15,300, right? Because it's 15.3%. What's your net? I stumped you now because I added the 300, right? 84,700, right? And then that's going to be subjected to income tax after that, right? That's your net. Now, the interesting thing is that's because this amount of money here is self-employment income. But if you simply file this one form 2553, you can choose to tell the IRS, I'd rather be taxed as an S corporation. What does that do for you? Well, an S corporation essentially says that not only are you a small business, but you're also an employee of your business. And you are then required to pay yourself a salary. It's called a reasonable salary. Everyone say reasonable. Reasonable. Now, I'm going to talk a little bit about how you can really finesse this in a minute, but let's assume for the moment that your reasonable salary is 50%, because again, it's easier from a math perspective. So again, we still have $150,000 of income here, so we're going to call this original. And then over here, we're going to call this S Corp. Okay, 150,000, 50,000, 150,000, and 50,000. Okay, so the net is the same, right? 100K. But now, in this environment, we're not paying ourselves because this is the original situation. It's a 1040. Any payment you're taking is going to be a draw from your business. Over here, though, you can choose to pay yourself a salary. So let's assume you're paying yourself $50,000. $50,000. You still have another $50,000, right? Only this, the salary, only the salary is subject to self-employment tax. This 50 is going to be a dividend that you get to take from your business. Dividends are not self-employment income. By this one form, in this scenario, you save $7,650 in taxes. One piece of paper. How many people could use $7,650 that if it was laying on the floor right now, you'd pick it up? I just gave you a strategy, one piece of paper strategy, to save you almost $8,000. One piece of paper, pretty simple to file. You just saved $8,000. And if your income's higher, save even more. Now here's the strategy. Reasonable is the key term. Now there's a lot of stuffy accountants out there that say reasonable is 50%. You can't go any lower than that. Well, I actually have this matrix that I talk about with clients. The matrix looks like this. The more you make, your reasonable salary actually goes down. So let's say in this scenario, it's $50,000, making $100,000. Maybe that reasonable point is here at 40% reasonable salary, 60% dividend. If you make a lot more, maybe it's 20%. How do I know this works? Joe Biden made nearly $15 million on a book deal. You know what he filed as reasonable salary? $650,000. The president could do it, so can you. The concept here is just understanding what the rules of the game are. These are what the wealthy people are playing with, these rules. You can take advantage of it. Now, there's another strategy that I want to make sure you don't leave here without learning, and that's this leveraging incentives. You see, the tax code itself, guys, if you take a look at the tax law itself, and then you evaluate all of the pieces of supporting information that the IRS puts out every year, what they refer to as regulations, or private letter rulings, or notices, the entirety of the tax code totals a little bit about 74 to 75,000 pages long. That's how long it is. That's how big it is. And about 70,000 of those pages are oriented towards business and real estate. And real estate, don't get me wrong, real estate done right is business. But if that much of the code is oriented there, you have to ask yourself why. It's because the tax code is an incentive program. It's designed to get you to do stuff. The government wants you to do certain things, and the way they incentivize you to do that is they give you this benefit called a tax deduction or a tax credit or some sort of tax exclusion. And when you learn to leverage incentives that are built into the code, you can actually understand that the government wants you to do X. X makes a lot of sense for other reasons, so let me do it and get a benefit in the form of a deduction or a credit or an exclusion. And the one I want to talk about today is this thing called bonus depreciation. Say bonus if you heard of bonus depreciation before. You probably heard about it wrong. See, most of these financial gurus online talk about this thing called section. What? 179. Section 179. Close though, love it. The problem with Section 179 is they have not read the code. See, Section 179 actually has a ton of limitations on it, what you can and can't do. There's actually this other section that came out in 2017. It's called Section 168K. Section 168K is actually what bonus depreciation is. Everyone talks about it here, and that's how you know they have no idea what they're talking about. So if anyone says bonus depreciation and they say 179, don't give them your money, because they don't know what they're talking about. Section 168K, however, is bonus depreciation. What that does, it gives you the ability to take a deduction for something you otherwise would not have been able to do so in year one. You get to take it in year one. Let me talk about what a deduction is for a second. You see, the IRS understands that businesses spend money, right? That's pretty common sense, right? They spend money. And the IRS says that if you spend money on something that doesn't really last a long time, doesn't have a really long, what's called a useful life, they let you take a thing called a deduction, right? It reduces your taxable income. Now, there's some rules that go into it. It has to be ordinary and it has to be necessary in your business to pursue. But if you spend the money on something like, let's say, a marker, the IRS says, well, this is not going to last that long. Therefore, at the end of the year, its value essentially expires, so we're going to let you take something called a deduction. Deduction reduces your taxable income, right? So deductions are good. They're not the best thing in the tax code. There's actually something really much, much better. But a deduction is good because it reduces your taxable income. Now, here's the interesting thing about this. If you buy something that's big, that actually has a useful life more than a year, the IRS says you can't really take a deduction for that because it still has value, right? The business has value in this thing. So they actually call that thing a capital expense. You're acquiring an asset that has capital value. And therefore they say, let's look at how long that value is going to last. Like, what is its useful life? And then based on that, you get to take what's called a depreciation deduction over a period of time. So a lot of people, especially over the course of the past two years, have been talking about real estate, right? Because real estate's the big driver. Don't get me wrong, I love real estate. I think it's an awesome ingredient for wealth creation. But the concept that they talk about is that we get to depreciate this piece of real estate over 27 and a half years. Or if it's commercial property, over 39 years. We get to take a deduction for what we just spent over a period of time, right? So that's the concept. Like, if you bought a house, let's say the depreciable value was, let's say, $900,000, and it's being depreciated, let's say, again, for simple math, over 30 years, how much would your deduction be each year? If you had to divide 900 by 30. $30,000 a year for 30 years. That's a pretty cool thing, right? You get to reduce your taxable income because you bought this piece of property over 30 years, approximately. What bonus depreciation does is it allows you to take anything that has a useful life of less than 20 years and essentially accelerate that deduction all in year one, right? It's pretty powerful. So in the scenario, let's say you bought a piece of property, and let's say the depreciable value for that property was $300,000, as an example. Because there's certain things that are never depreciable, and when we're talking about real estate, land, for instance, is never depreciable. And there are certain things that cannot be bonus depreciated, meaning any property or piece of the property that has a useful life beyond 20 years, or 20 years or longer. So in the $300,000 scenario, if you bonus depreciated that, in 2022, you could take a $300,000 deduction, right? That was really powerful for a lot of people in real estate because you got to really take a massive tax benefit simply by acquiring real estate. Now in 2023, that amount of depreciation is limited. So 168K has been limited essentially by 80%. So the maximum of whatever that amount of depreciation is limited by 80%. So in the case of $300,000 of depreciable value, your maximum in year one would be $240,000. I'll help you out with the math. But the concept here is it's still powerful, right? Now, everyone's thinking about this in the terms of real estate. I'm going to flip the switch. I'm going to give you a new thing to think about. It's anything that's a capital expense. You can bonus depreciate anything that's a capital expense. And when we're talking about the concept, I want you to think about, I'm going to use an example just to illustrate it. I'm not telling you to do this. Again, not giving you any specialized advice. But think about it from an example standpoint. Let's say you wanted to go out and buy an RV. You want to put it on a company called Outdoorsy, which is like the Airbnb for RVs. Let's say you want to spend, I don't know, you want to get a nice one. You want to buy a $100,000 RV. What's the maximum you could depreciate? An RV has a 15-year useful life, by the way, so you can maximum get an $80,000 deduction for that RV. Here's the interesting thing. How much do you think you have to pay to buy a $100,000 RV? It's about 20 grand. $20,000 to buy an RV because you can finance the other portion. If you paid out of pocket $20,000, you got an $80,000 deduction, and if your tax bracket was say close to 50%, you saved $40,000 in taxes. You spent 20 and you saved 40. What return is that, guys? It's a 200% return. 200% return. You haven't even cash flowed yet. You haven't even rented it yet. You just made 200% on your money. You get the tax savings, and now you just bought an asset. The asset is the most critical thing you can do in your wealth creation. Because if you're interested in financial freedom, how many people want financial freedom? Say financial freedom. I didn't hear you. You guys don't want financial freedom. Financial freedom, right? It is the most powerful freedom and the most important freedom to fight for because it literally leads to every other freedom. Every other freedom. Financial freedom gives you the freedom of education, gives you the freedom of health care, gets you the freedom of mobility. Come on. This is the most important thing. And we're not taught this stuff in school, guys. Like, how ridiculous is that? Financial freedom is the most important freedom to fight for, and you're not taught how to get it. This is why I hate the government. Because the government created our education system. In fact, it was that one gentleman, mostly, Rockefeller, because he didn't want a nation of thinkers, he wanted a nation of workers, right? And if it's the most important freedom, how do you go out and get it? Well, it's a simple 10-word formula. 10 words. Do you guys want to know what the formula for financial freedom is? Write this down. Free cash flow greater than your daily needs and wants. That's it. If you have more cash flow than what you're spending to live your life, you are in a state of financial freedom. Come on, right?
Can you write that?
Exactly. Yeah. But here's the thing. Here's the thing. For those who usually achieve it, the vast majority of people who get to that state, they do it in what I call a state of richness. Don't get me wrong. It's way better to be rich than it is to be poor. I've been both. But the problem with being rich means you're the one creating the free cash flow. You're doing the thing. You're engaged in the thing. And that means that it's never permanent. I went away for like a month and a half with my family. You know what happened to my cash flow? It went up. Because my assets are the things that are generating the cash flows. Because, see, I don't want you to be rich. I want you to be wealthy. Wealthy is the same thing. It's the same state of free cash flow greater than your daily needs and wants. Just it's no longer dependent upon you generating the cash flow. You've acquired the assets that are generating the cash flow for you. And if that happens, then you are wealthy. Now, wealthy is not permanent either, but it has permanence. Right? Because how many people have heard people who were seemingly wealthy lose it all? Right? I've never met a business owner that wants to get wealthy twice, right? Never met that person, but sometimes it happens, right? So wealthy is not necessarily foolproof, because you can still be a fool with money if you have a lot of it, right? But if you learn the rules and you understand that you can do things like understand that leverage is possible when you're leveraging incentives to go out and acquire a thing that in the first year of acquisition, you made 200% on your money, and then when it starts cash flowing, it's an asset. It's part of the key to getting, keeping, and growing real wealth. Now, the challenge is, most people who are sitting here, you may be taking notes, you're not going to do anything. I can't do the push-ups for you. But you can go out and you can start researching RVs tomorrow. It's just one example. Just one example. You can go out and acquire a business that already has big assets in it, like laundromats, as an example. You can buy a $125,000 laundromat. About $100,000 of that is equipment, washers and dryers. Now, I wouldn't advise laundromats right now because in 2023, they're trading at a 4x multiple. I wouldn't do that. But the concept is what I'm asking you to think about. Understand that there are things that you can do just by understanding the code. The code is incenting you to do this. Why? Bonus depreciation was put in to stimulate the economy. They wanted you to spend money because they were concerned about the economy. 2017, they were like, what's going to happen? We need to make sure that there's money going into the system because we have some things that we want to do that if we don't have enough money, there's going to be a problem. Well, they incentivize you to do this by saying you can accelerate something that before you couldn't. Because the only thing you could rely on at that time was 179. See, 179 did let you do some bonus depreciation as well, but there were a lot of limitations with it, and there still are. Like, for instance, in the equipment side, the maximum you can spend, still a lot of money, $1,060,000, right, on 179. But with bonus depreciation, there's no limit. You want to go buy $3 million worth of RVs, go have fun. You're going to save $2,400,000 off of your taxable income. It's going to reduce your taxable income. That's, for most people who are in that bracket, it's going to save them $1.2 million in taxes. That's real money in real pockets. Now, a lot of the pushback I get is, Edward, I don't know how to run an RV business. Then don't. Hire someone else to do it for you. You just made 200% on your money, right? It's built-in value. Go find another business that has large assets that you can bonus depreciate. Take advantage of the strategy. The government wants you to do it. They're incentivizing you to do it. They give you a big tax deduction if you do. Now, the third concept I want to share with you is this idea of income shifting. Just by a quick show of hands, how many people in the room have children? Okay, just a couple. How many people in the room pay someone or someone in some other way economically support someone who is not a spouse? Okay, excellent. Well, income shifting is a strategy for you. If either of those two scenarios fits the bill for you, income shifting is that strategy, because if you can hire your family member or someone you're supporting, you can get a tax deduction for doing that. Depending on their scenario, if their income tax bracket is lower than yours, you just won the game. Let me put this into perspective. I have 2 kids. So my son's going to turn 10 in January. My daughter just turned 8 back in September, although she acts like she's 18. That's why I have no hair. It just is what it is. It's the reality of life as a parent. I own a lot of different businesses. And I spend a lot of money on our family. Like, again, you saw that's the third largest expense of most people. I'm definitely there. I spend a lot of money on my family. But there's this cool thing called income shifting. So in my business, if I hire my child, I get to pay them up to $13,850 each year. I get to take a tax deduction for doing that in my business, and they pay 0 taxes. Income shifting. I shift the money from my tax bracket, which unfortunately it is higher than theirs, because theirs is 0. And I get to shift that money to the kids. Now, you may be saying, well, wait a minute, Edward, that's not a lot of money. It's $13,850. What? If you found almost $7,000 on the floor, you'd pick it up, right? No? Yeah. I don't care if you have $1 billion. You find $7,000 on the floor, even though it's changed to you, you're picking it up. Right? $13,850, one child. I have 2. Yeah, you see where I'm going here? I have a niece that I want to funnel some funds to because I'm economically supporting her because she wants to go to university. I pay her. from my business to actually do real work, right? This is a real thing, right? You can't just give money away. That's called gifting. That doesn't give you any tax benefits for doing it. But you pay them to do a real thing. I have my kids come to the studio and vacuum in the background of a video that I'm doing for Instagram, and I pay them modeling rates. There's a thing called SAG, Screen Actors Guild rates. They publish their rates. How much does a 9-year-old get paid for a 20-minute filming session? Well, it turns out it's almost $800. Yeah, $800, 2 hours. How long did we spend filming them? Maybe like 10 seconds on the actual clip that went on Instagram? But you know what's interesting? I didn't pay them for that. What I paid them was a licensing fee. You know how often that clip gets shown on Instagram? I pay them every time it gets shown. It lives perpetually. Completely legal. I'm a lawyer, specialized in tax, estate, and business law. This is why the wealthy stay wealthy, because they know the rules of the game. Stop playing Legos, guys. Play chess. Poker too. Have something complex, right? I had a very interesting thing happen to me in law school. I was sitting in contracts class, and the professor said something that I actually didn't know. Yeah, it happened. I didn't know it. And the interesting thing in law school, I don't know if there's any other lawyers in the room, but in law school, which is different than university, is they often practice something called the Socratic method, which means you have to stand up and you literally, the professor asks you questions, you respond, they ask you more questions, you respond, they ask you more questions. And the idea is you're supposed to learn that way. Well, I had no clue. And then I asked the professor the question, and he said, my job is not to teach you the language of the law. Go to the dictionary for that. He was right. It's our job to learn the language of the games we want to play. If you are not investing time to learn the language of money, shame on you. The wealthy speak the language of money. How often do you speak the language of money with your kids, if you have children? I do it all the time. I had a session with them around the table, and we were talking about, again, my son's 9, my daughter's 8. We were talking about the 3 words that every business owner needs to understand the meanings of: cost, price, value. I talked about it with a 9-year-old, an 8-year-old, because the limits that we have in life are all self-imposed. If you believe that's too complex of a topic for a 9-year-old, that's on you. Shame on you. My son knows that costs are the inputs that go into bringing a product or service to market. He can say it verbatim, but here's the key thing. He also knows what that means. He can give you examples. If you're not teaching your kids the language of money, they're definitely not learning it in school. Come on. Do you hear me? They're not learning it in school. If you don't know the language of money, it's because they didn't teach you the language of money in school. So shame on you. Invest the time to do the push-ups. I can't do them for you. Now, when we look at the entirety of everything that we're talking about, why is this critical for you to learn? Well, the problem is, this is the situation here in the United States. This was from this afternoon. I don't know if anyone has ever logged in to the usdebtclock.org. You should if you want nightmares. This was a snapshot from earlier today. This thing is in real time ticking up to the tune of hundreds of thousands of dollars a day. Let me focus your attention to this one big number. This is the national debt as of this afternoon. 33,669,791,000,000 $818,607 at that second. $33 trillion. This is a number that most people can't understand. Trillion. Let me break it down for you, because it's really important to understand perspective. How long ago, by just call it out, how long ago was 1 million seconds? Any guesses? 1 million seconds ago. How long ago was that? A million. How long ago was 1 million seconds? 13 days? Very close. 12 days. That's 1 million. 1 million seconds. How long ago do you think 1 billion seconds was? Call it out. 3.6 years, 30 years, 20 years. It's approximately 32 years ago. Here's an interesting one. How long ago was 1 trillion seconds? 3,200. About 33,000 years ago. The difference between a million, a billion, and a trillion. And we have $33 trillion of debt. Let me go back to something a second, because you need to see this. This is the amount of tax revenue. It's $4 trillion a year. You know how much we're spending? 6 trillion. That's why if you look at this number here, where is it? Right here. Federal deficit, as of today, at the second that I printed this out, 1,717,000,000. That means they didn't collect enough taxes from us, but they spent the money already. So that's called borrowing. They issue debt in order to have that happen. But here's the problem. The debt is constantly being issued now at higher and higher interest rates because of all the other crap that's going on in the economy, because of what the government did and the policies that are stupid, because we have stupid people who make stupid decisions in government, right? I'm an unapologetic capitalist, guys. We have people who don't understand money making money decisions for you and me. We should. Problem is, the system's broken. But because of this, the logical conclusion is that they're going to have to fix this. And the only way that happens is by doing two things. And you tell me which is more likely. I'm going to let you decide. This is audience participation. They have two ways of fixing this. One, they cut spending. I mean, people think that's a reality. The other way is to raise revenue, raise capital. How do they do that? Taxation. Right? So if you don't learn the rules of the game, you're going to be paying for it. That's your choice. Now, remember what I talked about in the very, very beginning? We talked about family, the cost there. I gave you a tax strategy to help you reduce that cost, because you're still spending the money. I'm still spending the money on my kids. It's just now I get a tax deduction for doing it. Tax is the second, but what's the number one expense, do you think? Inflation. That's a good one. Any other guesses? Ignorance. So I have a question. How many people in the room would like to be earning $1 million a year right now? Don't answer this question, but I want you to picture it in your mind. How much are you earning right now? Don't answer it. Picture it in your mind. But you want to be earning $1 million. Let's say you earn $100,000 a year. Well, if you're earning $100,000 a year, but you want to be earning $1 million a year, It's costing you $900,000 a year not to know how. That's a real cost. You want to be earning $1 million. It's possible. How many people earn $1 million? A lot, right? We're in Miami. There are people here earning $1 million a year. And if you're not one of them, it's costing you $900,000 not to know how. That's a hell of a tuition, guys. You're paying it every year. Paying it every year. I taught you some strategies of figuring out how to keep more of what you're making, right? But you have to go out and figure out how to employ more of them. And the only way that happens is for you to understand that knowledge is power. You need to understand that there's a difference, though, between knowing the what, right? Like what is the thing, like taxation and tax reduction strategies, that's the what, right? But you also need to know the how. Now, here, but I'm going to give you a clue. You actually don't need to know the how. But you do need 7 words. 7 words for this solution. In this concept of understanding what actually moves the needle, you put yourself into a room, you put yourself into the company of those who know the how. 7 words. Find the who to implement the how in your life. If you want tax reduction, find a tax reduction specialist. Hire them to put more money in your pocket. If you want to grow and scale your marketing efforts, hire a marketing specialist that you can go and drive more revenues. If you want to get into a scenario where you can network with awesome people, you connect with Melissa and you join her group. I can't do the push-ups for you. I can tell you how to do them. This is 100% going to be on you. And if you're interested in getting in the know, if you want to know how to do it, we're launching a newsletter, completely free. I'm just going to be giving you my ideas, my thoughts. If you're interested in learning, just sign up for it. We're launching it in November, and I'm just going to be sharing the practical wisdom I talk about all the time. How many people follow me on social media at all? I give practical wisdom, right, guys? Yeah. I just tell you like it is. Why? Because I didn't learn this stuff when I was getting started. I didn't know it. In fact, I learned all the bad stuff, and I was relying on people who didn't know it either. I thought the accountant knew it. No, he barely got the returns done for me. So much so that I got so frustrated with accounting in general, I started my own firm. Because I'm an unapologetic capitalist, and I love business. And the concept, though, is can you get in the know? It is possible. I'm not telling you anything that's impossible, right? I'm not telling you how to get to Pluto, right? Because I have no idea if that's even possible. I don't know anyone who's ever been there. But I can tell you how to get to 30,000 feet. Happens every day, right? You want to know how? Go to the airport, buy a ticket, go through security, go to the gate, get on the plane, stay on the plane when it takes off. 30,000 feet, right? So the concepts here are just reverse engineering. Just understand, in order to do that though, you need to talk the language. Learn the language of the game you want to be playing. I can't do the push-ups for you, but I can show you how they're done. Thanks, guys.
That was so epic. That was so, wait. All right, so we're gonna do a quick Q&A here. Is that okay with you? All right. So, yeah, we do have plenty of time, actually.
Before we do that.
Yeah, you gotta do one of those, little videos, like.
I'm at Epic Talks Miami. Look at these guys.
Woo!
We learned some awesome things about tax, did we?
Yes!
Bye for now.
All right, so questions. Ready? Eric Mendelson right here. Stand up.
Hey, buddy. As you know, I'm a real estate agent, so I understand what you're talking about in terms of depreciation, residential 27 and a half years and commercial 39. You can take 20 years of that on residential and or commercial, or is it just commercial or neither?
It's both. So I'll break it down for you quickly. When you're talking about something called No. So most people who are in real estate have already started doing something with regard to depreciation, right? The IRS gives you something called straight line depreciation. It's a safe harbor. It's like a simplified method, right? It's actually improper. It's actually improper. If you actually look at the tax code, it literally says if you do this, it is an impermissible method. That's the phraseology, impermissible method. But they let you do it because it's easy, right? You simply just divide the depreciable value. And when we're talking about real estate, we're talking about the value of the building, the stuff in it, and the stuff around it, just not the land, right? So if it's residential, it's 27 and a half years. If it's commercial, it's 39 years. 39 years. Now, when you're depreciating straight line, you simply divide the value of the property minus the land, and you just divide it by these numbers. And then every year you're taking it. So most real estate people are doing that already in their thing. But that's improper. It's an impermissible method. So you have to actually file another piece of paper, 3115. And this allows you to recalculate how you're depreciating stuff. You have to request it, though. You have to actually file it. Once you do that, you can recalculate what you've already done, and you can potentially bonus depreciate, but you have to do something called, you may have heard of this, a cost seg, or segregation, study. A cost segregation study, basically hiring someone who's really specialized in the area of real estate. They understand the components that go into real estate, and they literally walk through the property and they take a look at everything. They walk in the door, they look up and say, oh, that's a nice chandelier. Oh, that's interesting flooring. Oh, that's a great cabinet. Oh, I love that dishwasher. That hot water heater is amazing. And they literally break out every component inside the property and organize it so that all of the same useful life property is categorized together. So everything that's 1 year, everything that's 5 year, everything that's 7 year, everything that's 15 year, they categorize it. Everything that's 20 years and greater, you can't bonus depreciate. Not allowed to. But everything else, you can. And on average, this is a rule of thumb, this is not giving you advice, but on average, about 1/3 of the value of the property is going to be fitting into that 15-year or less property. So again, if you had a $900,000 property, about 1/3 of that, $300,000, is going to be available for bonus depreciation, and you can get a deduction this year of $240,000. Boom. Definitely.
Another question. Yes. What's your name?
Josema, what's up? Edward? So what happens when you sell something, an asset that you have already depreciated?
Yeah, there's this nasty thing called depreciation recapture. But you never sell it, or if you do, and if it's allowed, you simply kick the can down the road by, in real estate, doing a 1031 exchange. So 1031 exchange takes the entirety of the basis and just pushes it into the new property. So you don't actually have to pay taxes. There's this amazing thing, guys. BBD. Buy, borrow, and die, right? Keep the real estate forever, right? So if you have to sell, you sell inside of something called a 1031 exchange. You kick the can down the road. You continue to borrow against that property as it appreciates, because borrowed money is tax-free. And then you die with the property, and when you die with the property gets a step up in basis so that when your heirs sell it, the day after you die, there's zero tax. That's how the wealthy stay wealthy. They know the rules of the game. Great question.
Andy,
very
you don't-
true. It has to be business
have a
assets.
question? You have a question, Andy? No. Here.
Yes.
I guess you didn't really talk about the standard deductions, and I think you applied that towards
The children.
when you talk about the kids, right?
Yeah.
And is there a limitation on the amount of deductions you can get in
So
terms of kids?
$13,850 at the federal level. Every state is going to have, if the state has income tax, the state may have a standard deduction rate that is different than the federal government. There are about 24 states that have a different standard deduction rate. Florida doesn't have an income tax, so there is no standard deduction in Florida, so it's just the federal rate. So the limitation, though, is on two things. One, whatever the standard deduction is, and two, the actual work that your kids are doing. It has to be a real compensation for real work rendered, right? You can't just give them $13,850. You actually have to actually do something. But here's the key. You can pay them $30,000 if you want. Their tax bracket is lower than yours. It makes sense to do it. The other thing you could do is you can tack on, if you want, you can tack on an extra $6,500 and let them take an IRA deduction. Yeah, they have earned income. Now, you really want to do something, you don't care about paying taxes now, you make that a Roth IRA contribution. And then it's tax-free for them forever. And then you really want to take it to the next level. I'm dropping gold here, guys. You get it to be a self-directed IRA, and then you let your child's IRA invest with you in a piece of real estate.
Can I just follow up with this? Typically, when I used to do a lot of preparation, what we'll notice is a lot of people would ask for the Schedule E.
Yep.
That would allow them to put multiple properties
Yep.
or even a single property to allow them to have that deduction and lower their costs. So that would save them a lot in taxes.
That's one way, but I'll add something to it.
Sure.
So Schedule E, page 1, is where most real estate professionals or individuals who are owning real estate will have their income flow to. It's page 1 of Schedule E. That's great, but the challenge is if you're borrowing money, if you're interested in really getting an empire of real estate, you're probably going to go get funding. Most banks, when they're evaluating your income, and if they look at your tax return, they're going to look at Schedule E, page 1, and they're going to consider you a novice when it comes to real estate. So they discount that amount of money on Schedule 1, page E, by 25%. It's pretty standard practice. So if you made $100,000 of rental income, they're going to say you only have $75,000 because you're not really a professional, so you're a risk, so we're going to reduce it. The way to get around that is simply get your income on real estate to flow to page 2 of your Schedule E. Because page 2, there is no discounting. How do you get to page 2? Well, you just have to be a professional. How do you be a professional? Well, instead of getting the money coming to you directly, you get it in the form of a K-1. You simply form a partnership with your spouse. If you're not married, you just have 2 different trusts that are your trusts, and both of them become the partners in a piece of real estate. And now that piece of real estate will file something called a 1065, which is a partnership return, and partnership returns issue a K-1. K-1 flows to page 2, which means that the $100,000 of income you have, the bank, the lender, is going to consider all of it when they're factoring in eligibility for more loans. Please. Yep. Yep. Mm-hmm. Yeah, any asset that has a useful life beyond a year, intellectual property is an excellent example of that. Any asset that has a useful life beyond a year, you can bonus depreciate into year 1. Whether it's a physical thing, whether it's an intellectual thing, whether it's a domain or a series of domains. We own 327 domains now, I think. So all of those things are assets. Some of them cost a lot of money, some of them don't cost much, but I get to now bonus depreciate those in year 1 if I want. Awesome. What other questions?
All right. What's your name?
Edgar. My name is Edgar.
Edgar. 2 Eds are better than 1. I love it.
Can you only bonus depreciate on the first year after you buy the property?
So
Okay, so property.
yes, bonus depreciation accelerates that depreciation amount into year 1. But remember, we're maxing out 80%. There's still 20% left. And that just goes through something called MACers, or makers, depending on who you talk about. But makers essentially is whatever the useful life that's left. Like, so if it's 15 years, that balance, that 20% value is just now depreciated over 15 years.
Now, what if you didn't depreciate that 80% the first year?
Yeah,
So
then you
that's
have
my question.
you have to go through this recalculation, 3115. Well, if you never depreciated it, you may have to amend your return, right? Because that was an event that occurred in a prior year, like when you acquired it. So if you never depreciated it, you may have to go through an amendment. You should talk with your tax preparer as with regard to what the best methodology for you will be.
And if you buy a property and you get that 80% the first year and you renovate, would you then be able to
Yeah,
depreciate
I call
what
it
you
double
renovate?
dipping. Yeah, I call it double
Can you-
dipping. What you have to do, though, is you have to put the property into service, so you rent it first, then you renovate it, right? So if you're doing short-term rentals, you put it on Airbnb and you rent it out for one day. You do your cost seg, you get the tax deduction for that, then you rip out all the cabinets. And you put new cabinets in, and you get to depreciate those too.
Great.
Yeah, it's called double dipping. It's a strategy that really good real estate professionals engage in, because most real estate investors are looking to do something called forced if I can write, appreciation, something like that. I was almost there. Forced appreciation simply means you buy a property that may be like a B-class property right now. You put a tenant in there, you do your cost seg, you get the deduction for all the stuff you know you're going to rip out. So why not take the deduction? Because if you rip it out, once it's out, it's out. You can't depreciate it anymore. It has to be in service. That's the only way it works. Then once it's in service and that tenant leaves, that one night stay leaves, then you have the contractor go in and rip everything out because you already got the tax deduction for it, right? Then you do a new cost seg. Now it may not be worthwhile to do. You have to figure out your analysis, but there are plenty of ways it would work really good, and usually that is in something called multifamily. And the reason for that is multifamily has a lot of 15-year or less useful property in it. You have one roof, one set of outer walls. That's all the stuff that's like 20-year plus property. This is one of them. But if it's a 4-unit property or 5-unit property or 10-unit property, you have 10 cabinets, 10 countertops, 10 floorings, 10 like everything. So all of those things are bonus depreciable. So remember how I said 1/3 is the rule of thumb? 1/3 is the rule of thumb for residential single family. But when you have like multifamily, maybe it's closer to 40 or 50%. It's available for bonus depreciation. But the strategy itself is the thing that is most powerful, right? It's like understanding the incentives that the government says they want. They want real estate, so that's why they incent this action. Go out, get it, and then we'll give you a benefit by giving you a tax deduction. Now, there are other strategies to pair this with, right? Like being able to pull passive losses into non-passive to offset your non-passive income. There's a lot of other strategies. I just talked about one. You should ask a lot of how questions to the people that you trust.
Great. Thank you.
You're welcome.
Great answer.
Awesome.
One more question. Anybody? Yeah, Angela and Chris. Come on, my two favorite people here. Let's go. Angela, come over here.
So I've been able to get some like brand affiliate deals recently.
Awesome.
It's really only a couple grand, but
Okay.
would that be worth starting a whole new S corp or
So-
commingle for now and
so-
see how it goes? Or what?
I am an advocate for structure, right? Having the right structure in place. I have this thing I call the real wealth matrix, which is what I believe to be the ideal hierarchy of ownership over everything in your life. So the real wealth matrix, it's essentially organizational structure for ownership. If you follow me on social media, I talk about this all the time. I came up with this back in the probably about mid-2000s. Attorneys all across the country use it now because it works, right? The concept is, how do you own everything, right? When you're talking about your ownership structure, Chris, on your side, what we're talking about is non-passive here, right? So we're talking about the non-passive side in this regard, because brand affiliates potentially is you actively engaging and doing something. So the ideal hierarchy would incorporate a trust of some sort, okay? It would own a holding company, and the holding company would own the operating company, right, the OC, okay? That's the ideal ownership. Here, the holding company level is where we do the S corp, right? So what may make sense is instead of having one, you have two operating companies, right? Both of these would be single member LLCs because I don't want to file a tax return for them. They're disregarded. Single member, all the income flows up to the holding company. So I file one tax return. You can have 20 of these if you wanted to. 20 different businesses. I like segregating liability. I like keeping like kind liability in the same place because, again, I never met a business owner that wants to have to get wealthy twice. So segregate your liability. These are two different types of liability. Main business liability, the brand affiliation deal. It's a different type of liability. So why should they shouldn't be in the same business. But this is the only place that is dealing with the S corp.
Okay.
All of the income flows up to the holding company under the real wealth matrix. But great question.
Thanks.
Hello, hello, hello.
Hello, hello. I'm totally geeking out, by the way. I've been sitting here, they're like, looking at me funny. Can you teach us in the room the differences between the business write-offs on the smaller vehicles versus the larger vehicles?
Yes, so when we're talking about vehicles in general, right? There are two main categories of vehicles that the IRS cares about. One is big things, the other is little things, right? So when we're talking about big things, being big, heavy equipment, if it's 6,000 pounds or more, it's available for what is referred to as accelerated depreciation, that 168K, right? 168K. Because it doesn't matter how much it's worth, right? You could buy a big vehicle for $600,000. You may say, wait, no way. Yeah, like think about large equipment, dump trucks, like big, heavy haulers, right? That's a piece of equipment, it's a business equipment. Now, here's the key point. It must be at least 50% business utilization. If it's less than 50% business utilization, you cannot bonus depreciate at all, like zero bonus depreciation. You may still be able to do 179K, but Section 179, not K. Section 179, but you're going to have limits because Section 179 has a lot of limits that are associated with it. One of the limits is luxury. If it's a luxury vehicle and it weighs less than 6,000 pounds, you're not going to be able to depreciate much because any dollar over $50,000 starts to reduce your ability to bonus depreciation. So if you're buying like a $100,000 vehicle, you've wiped out all of your ability to do 179. That's why anyone who's telling you use 179 to deduct your vehicle doesn't know what they're talking about because you literally, most cars today are expensive. You know what the average cost of a vehicle is in the United States right now? $48,000. When I was a kid, it was a long time ago, it was 16. Inflation. They're coming for your money, guys. Learn the language of money. It's another tax. It's the one that you didn't vote for. No one did, but it happens because it's done by policymakers. But that's the biggest difference between big stuff and little stuff. Big stuff is available for 168K, which doesn't matter the cost. Little stuff is going to be limited by the limitations of 179. And the luxury limitation is the big one. Like if it's a vehicle that is worth more than $60,000, you have issues. And if you're going to go that route, if you're going to be a business owner and you want a luxury vehicle, but it's not going to weigh a lot, well, the way around this is to do something called leasing. Because leasing is renting. That's 100% of a deduction. All of your lease expenses associated with that vehicle. So you don't really lose because in reality, a portion of the value, the capital value, is incorporated into lease value. Now there's implied depreciation that occurs in a lease, but you don't have to worry about the limitations of 179 because it's allowable rent deduction. But great question. I told you guys I'm a nerd when it comes to this stuff. I love it because I literally hate the IRS. I want to figure out how I can pay them the least amount possible, and I want you to as well. Awesome.
Yes, thank you.